Carl, it's been a little while since Weekly Sense, but we've been a little busy, right?
We have. It's been a busy summer and a busy year, and so we have some sense finally to.
To talk about. Yeah, and I think we can't really start this Weekly Sense without talking about what happened in Jackson Hole just a little while ago. You know, the Fed came out and basically put the market in its place, right?
Yeah, I mean, it sounded like Powell doesn't want to be known as the guy who let inflation get out of control. So, they were talking tough, and then they started raising rates, and people said they were behind for the longest time, and arguably they still might be a little bit. The market's been expecting inflation to come down, and it hasn't yet, although we had one good data point last month, and we probably will start seeing some more.
Right.
But we don't know yet until we actually have seen it. But yeah, I mean, what happened after everything really got volatile and declined a lot going into June. People started to get worried about a recession, and then bond yields fell, and people were thinking, oh, well, maybe the Fed will slow down and do a dovish pivot like they did
Right.
in 2018 and
Yeah, and
19.
that's what we
And
talked about in
so the
our
market,
in our mid-year
yeah, so we had
review.
this bear market rally, and then it seems like the Jackson Hole speech killed it.
Yeah, it was I think just a week before the Jackson Hole meeting when we had our mid-year review, talking about this whole notion that the market really believed in the soft landing and showing the statistics that it really only happens, I think 3 times over the last 70 years, and all 3 of those times inflation has been under 4 or 4.5%. But I wanted to pull up a couple of key statements. I don't want to read these off to you and just kind of get your feedback. These were statements that Chairman Powell made. Here's the first one. Restoring price stability will take some time and requires using our tools forcefully to bring demand and supply into better balance. Reducing inflation is likely to require a sustained period of below trend growth. So what do you think about that?
It's all true, versus history and what we're seeing now. Do you have the quote about him saying there needs to be some pain?
Hey, you're getting ahead of me, buddy. You're getting way ahead of me. Yeah.
Okay.
Yeah, no. So I mean, he actually finally came out and said that, this is going to result in slower growth for a prolonged period of time. And what was really interesting is that they're actually taking their dual mandate serious. And some skeptics think that they may not take it serious enough and may not have the gusto to push forward.
Yeah,
And to
well, they
those,
may not. I mean, they've
yeah,
had a credibility problem so far with being behind.
right.
And the biggest risk now, like, when he says that we want to get inflation back down to 2%, do they really want that? I mean, everybody is kind of estimating that won't be so painful. Maybe we'll have a little bit of unemployment increase. But most people seem to be entertaining this vision that there could be a soft landing, even though, as we've said, historical data don't support that at all,
Right.
really.
I think most people get tricked into the saying of, this time it's different, right? When
Yeah,
usually
so
it's
the
when
so the
usually it's
risk
not.
the risk is that we start getting some, we get into the recession and we start having unemployment go up, but it gets too painful, and when inflation's only 3 or 4%, they're like, we need to cut rates and start QE again. Like,
Yeah,
that's kind of the
that's
risk.
that's a possibility. But that brings me to this next quote. So I'm going to read it again here. Restoring price stability will take some time and requiring using our tools forcefully, keyword forcefully, right? Meaning aggressive rate hikes to bring demand and supply into a better place. Reducing inflation is likely to require a sustained period of below trend growth. And moreover, there will very likely be some softening of labor market conditions. While higher interest rates, slower growth, and softer labor markets conditions will bring down inflation, here's your key point, Carl. They will also bring some pain to households and businesses. And there are unfortunate costs of reducing inflation. Yeah, there's unfortunate cost of reducing inflation, and maybe they should have thought about that before they printed $5 trillion of new money supply, because the unfortunate cost of inflation are people lose their jobs, people lose their homes, people lose their businesses, and people lose a large amount of their portfolio assets
Yeah.
because they're not positioned properly, or they think that everything is rosy.
Yeah, the most expensive job to retain in the whole country has been Jerome Powell's job.
Yeah, that's, I look, and I wouldn't want to be in his position. It's tough to win unless you're in a bull market, right? Janet Yellen had to make a decent number of tough decisions during her tenure, but she had the grace of being in a bull market during that period of time. So the market was very forgiving. But yeah, what they've said is that it's going to cause some pain. And you can see modest increases of unemployment, but that modest increase of unemployment will drastically impact what companies earn. And what companies earn, if that goes down even modestly, in my opinion, they're overvalued at this standpoint.
Yes, and the unfortunate reality is that what the Fed does, while people like to think and say that it's not really political, ultimately it is, because those people get appointed for terms depending on the politicians that are in office who are elected by the people, and it depends on like how they're thinking and what their financial situation is. Like all of that plays into how they vote.
Of course. So big news today, Scott Minerd from Guggenheim. And, I'm a big fan of his. He's not always right, but he's got a good head on his shoulders. Came out with some pretty drastic news after the market closed today, calling for a 20% drop in equity prices between now and mid-October. And we were watching what Richard Bernstein was saying about that, joking that, he finds it funny predicting, 4 to 6 weeks of equity performance. But he shared an interesting chart, and I want to pull this up and then we can kind of talk about this a little bit. But what this chart looks at is essentially on the bottom of this chart, you see historical inflation numbers. Right now, we've got core PCE, I think, at about 4.6%. And current equity valuations are roughly 19 times earnings, somewhere right around there. And historically, this number right here, when you have core PCE or core inflation, somewhere between 4 to 5%, equity valuation should only be about 15.5 times or 15.2 times. So that implies a pretty drastic drop. I mean, that would be roughly about 3,000 on the S&P 500.
Maybe like 3,200 or so.
Yeah.
Yeah, I mean, it makes sense. I mean, I think there's downside, and we expect more volatility here going into the election. And maybe things could go back down to where they were in June, or maybe a bit below. It's hard to see like a real collapse until we start seeing some pressure on corporate earnings from interest expense going up, or some real deterioration in the labor market. So I just think it's a little hard to get all of that quickly.
Yeah.
Um,
But I mean, it comes back to the first quote that I said, right? That, the peril of believing in that this time is different, where historically, when we've had inflation or somewhere around where we have it now, the stock market tends to trade at a PE of, roughly 15. So, obviously there's got to be a catalyst that gets us there. And what he was discussing was the fact that, this aggressive rate policy is going to really start to affect corporate earnings in a much more meaningful way. And maybe you see a negative reaction to the 75 basis points move, like what you saw in April
or June.
or June.
Yeah, I mean, it's possible. We'll see. I mean, historically, September is a bad month. Going into the fall, like the days are getting shorter and darker, and the animal spirits are going in the opposite direction all the way through Halloween. And historically, going back, centuries, like most of the return in equity markets is between Halloween and Easter.
Right.
It's just and I think it's mainly an animal spirits, are the days getting darker, brighter kind of thing. So we'll see. And you often after elections, things bounce quite a bit. So we're very aware of all of that. And who knows, like things may not be like that this year, but historically, statistically, they are things that, things are like that. So that's why Halloween is my favorite holiday,
Oh,
not
wow.
just because of the dressing up, but statistically, it's the best time of the year to be investing.
Well, I am excited to see what costume you decide to wear this year.
Yeah, will it be scary or will it be
Funny.
funny?
Yeah. So speaking of something that's not funny, let's talk about how higher rates impact corporate credit. Why don't you give us the deal on that?
The very basic thing is that it's just like the housing market. Like when you think about housing and people thinking about buying new homes,
Right.
if they need a mortgage and they're going to go out and go through the whole application process and get one, when you look at your income, if you have to have a much higher interest rate, you're going to be able to afford less of a mortgage on average and less house. And so that's what's slowing down the housing market. The same kind of principle works over in the stock market
Mm-hmm.
because companies are borrowers for the most part, just like people taking out mortgages to buy homes.
Right.
There are some companies with balance sheets with no debt, but most companies have some amount of debt. They all have credit facilities which they use for short-term purposes, but when they go to do acquisitions or any big like investment program or growth plan, often there's some debt involved. And the world's been living on low interest rates for the last 5 to 10 years. And last time interest rates were this high was very briefly in the fall of 2018, and then things got volatile and had problems. And then I think before that you had to go back to 2013 and 14.
Yeah.
So because of all that, like the acquisitions and the things that have been done, like in the last 5 to 10 years, but also in the last two in response to COVID, there's been a lot of corporate activity and acquisitions in response to that. Like Amazon has hired tons of workers to, you know, staff their factories, a lot like stay-at-home economy stuff. There's been all this investment in that, and it's probably not too excessive, but to the extent there's been like debt taken out for those things and it was issued at say maybe 1 to 2%, and now that treasury yields are up at 3.5, and there's going to be some premium on that because like corporations are a little more risky than the government.
Yeah.
When that has to get refinanced at maybe 4 or 5%, similar to like someone moving to a new home and taking out a new like home mortgage at a higher rate, companies are going to have to pay higher interest expenses.
Yeah.
So
And
that's going to
that
eat into
inevitably
their
could hit
that'll
earnings,
take
not
it a bite out of
bankruptcy.
their operating income, and that'll trickle down to net income and earnings.
Or even worse. So if their credit rating isn't good enough or their balance sheet isn't strong enough, they may not even be able to find the lending available. Case in point, Cineworld, who just closed, right? They weren't able to find and roll their credit out because of their balance sheet, and they were forced to declare bankruptcy. And we
Right. If you
figure it
have a
all out.
really bloated balance sheet and a business model that's struggling, maybe having some revenue problems already
Right.
for other reasons, Bed Bath and Beyond is probably a good example of that. We were looking at that recently, and I think it's lucky that rallied like a month ago, and some people did well as a result of that, because it's not doing real well and they've got a lot of debt, and now the interest expense is really high and it's going to go up. But there are a lot of companies that are just kind of in these older industries where they've done a lot of acquisitions. Maybe it's competitive, they don't have pricing power, and
Right.
they have a lot of debt. And like companies like AT&T and Verizon are good examples of that. Probably everything with good margin, like high margins, that not too competitive, hasn't done a lot of acquisitions, is probably fine. But this is all going to affect a lot of companies.
Of course, yeah, especially
going
when
to
they have to
start to s-
refinance that debt at a much higher rate.
Right.
Yeah.
We'll start seeing it. And because, it doesn't just apply to like, short-term debt. I mean, it applies to everything, because what companies do is they don't just have long-term debt, they have a debt ladder. Just like, if you wanted to construct a bond portfolio, some people might tell you to construct a ladder where you have some long-term, some intermediate, and some short-term. Well, that's what companies do. So
Right.
when they have some short-term debt due, they're probably, then they have to go out now and then decide, do we want to do short term? Do we want to do intermediate term with the new
Yeah.
funds, or do we want to do longer term? And the truth right now is, like, it doesn't matter what you pick, because interest rates at the short end are about the same as they are at the long end, and they're continuing to go up.
If not
So
higher.
you can either go higher short term, or you can go higher and lock it in. It's like a pick your poison situation.
Sure. But they're all going to be higher. Yeah, that's interesting.
Right. And the same thing goes for the federal government. We've looked at that and written about that a little bit, how we expected their interest expense to go up to the tune of $300 billion or so this year.
Yeah.
And,
Well,
and since the equity market's been volatile, people probably don't have the gains that, that they've, the government estimated that they would have when they made their projections as to what the tax revenues for this year would be. So, tax revenues might be a little bit lower this year than expected, and interest expense might be a little higher over there as well. So at some point, that's going to start to crimp their ability to continue to spend.
sure. We'll see if it happens. Only the people in Congress can decide that. So before I let you go, we have to make a prediction. Carl, are you ready for a prediction?
Sure.
Okay. So football season kicks off tonight. Who's going to win the Super Bowl? I'll go first. I'll go with the Las Vegas Raiders, home team.
I have no idea. I haven't put much thought into that.
You can just pick a random team. Let's have fun with it. There's no wrong answer.
I really have no idea who to pick. Maybe the Denver Broncos.
There you go. Denver Broncos and Las Vegas Raiders. You heard it here, folks. All right, Carl, that's Weekly Sense. Just trying to keep everybody informed. We are positioned very conservatively going into the election. Things can obviously change, but I like where we're positioned now. Thanks, Carl. Appreciate it.
I do too. Thanks, Andrew.
All opinions expressed by Andrew Whalen, employees at Whalen Financial, or any other podcast guest are solely their own opinions and do not reflect the opinion of Whalen Financial. Whalen Financial is a registered investment advisor. This podcast is for information purposes only and should not be relied upon for investment decisions. Clients of Whalen Financial may maintain positions in the securities discussed in this podcast.